Hello everyone, I am Maheswai, Assistant Professor, Department of Commerce with CA, JJ College of Arts and Science, Pudukottai. In this video, I am going to explain marginal costing. Marginal costing is a costing technique wherein the marginal cost, that is variable cost, is charged into units of cost, while the fixed cost for the period is completely written off against the contribution. As settlement of cost and measuring the impact on profit of the change in the volume of output or type of output. Marginal costing is a very useful technique of costing for decision making. In marginal costing, costs are segregated into fixed and variable. Format of marginal cost: particulars of direct material, direct labor, direct expenses, total value of prime cost, and add up total variable overheads, total value of marginal cost per unit. Features of marginal costing: it is a technique of costing which is used to ascertain the marginal cost and to know the impact of variable cost on the volume of output. Selling price is based on marginal cost plus the contribution. Profit is calculated by deducting marginal cost and fixed cost from sales. The profitability of product or department is based on contribution made available by each product or department. Cost volume profit analysis is one of the integral parts of marginal costing. Valuation of stock of work in progress and finished goods is done on the basis of marginal cost. Advantages of marginal cost: it is simple to understand and easy to operate. It helps in evaluation of performance of different departments, divisions, product and salesmen, etc. It helps in cost control by concentrating on variable cost as a fixed cost is non-controllable in the short period. It provides the management with a useful technique like break-even analysis, profit value ratio, etc. It is a very useful tool of profit planning. It guides the management about the profitability at various level of production and sales. Limitation of marginal costing: the classification of total cost into fixed cost, variable cost is difficult. In this technique, fixed costs are totally eliminated for the valuation of inventory of finished and semi-finished goods. Such elimination affects the profitability adversely. The marginal costing historical data is used while management decisions are related to future events. It does not provide any standard for the evaluation of performance. Selling price fixed on the basis of marginal cost will be useful only for short period of time. Assessment of profitability on the marginal cost base can be used only in short period of time. Some concept terms of marginal costing: fixed cost, variable cost, contribution, profit value ratio, break even point, margin of safety, cost value profit analysis. First one, fixed cost, known as period cost or time cost, does not depend on volume of production and sales. Fixed costs remain constant. Fixed costs are fixed in unit. For example, salary, rent, manager's salary, etc. It's also known as fixed overheads. Variable cost: increase and decrease in proportion to sales and output. It's also called product cost or manage marginal cost. Vary in direct proportion to output. Variable costs vary in total, but they remain constant per unit. For example, direct material, direct wages, etc. Next one, contribution. Contribution is the difference between sales and variable cost. Contribution is also known as contribution margin or gross margin. Formulas: contribution equal sales minus variable cost. Contribution equal fixed expenses plus profit. Contribution equal fixed cost, contribution minus fixed cost equal profit. Contribution plus variable cost equals sales. Sales minus variable cost equal to fixed cost plus profit by loss. Next one, profit volume ratio by contribution to sales. Profit value ratio indicates the relationship between contribution and sales and is usually expressed in percentage. High profit volume ratio indicate high profitability. Low profit volume ratio indicate low profitability. Formula of profit volume ratio: contribution by sales into 100 or sales minus variable cost by sales into 100 or fixed expenses plus profit by sales into 100 or expenses in profit or contribution by sales in change in sales into 100. Next one, break even point. The break even points can be defined as a point where total cost expenses and total cost sales revenue are equal. Break even point can be described as a point where there is no net profit or loss. Total sales revenue equal to total cost incurred. Formula for break even point: in units, fixed cost by contribution per unit. Break even point rupees, fixed cost by contribution sales ratio. Next one, marginal, margin of safety. Margin of safety measures the distance between budgeted sales and break-even sales. Margin of safety: actual sales minus break-even sales. Margin of safety equal profit by profit volume ratio. Next one, cost value profit. Cost value profit analysis or cost value profit is something companies use to figures output out how changes in cost and value affect the operating expenses and net income. Cost value profit work by comparing different relationships such as the cost of operating and producing goods, the amount of goods, and profit generating from the sale of those goods. Cost value profit analysis gives companies strong insight into the profitability of their product or service. Cost value price analysis is a way to find out how changes in variable and fixed cost affect a firm profit. Companies can use the formula result to see how many units they need to sell to break even, cover all costs or reach a certain minimum profit margin. Elements of CVP analysis. There are three elements of involved. Cost, which means the expenses involved in producing or selling a product or service. Value, which means the number of units produced in the case of physical product or the amount of service sold. Profit, which means the difference between the selling price of a product or service minus the cost of produce or providing it. Thank you.